Hi guys, welcome back to my YouTube channel. So my name is Karabo Sithole, and in today's video we are going to be doing a video on corporate governance and insider trading. If you haven't subscribed, please make sure you click that subscribe button. It's really going to be appreciated. Make sure you watch till the end of this video. So the first thing that we're going to cover is corporate governance, right? So in order to understand what corporate governance is and how do we make sure as an entity that we have corporate governance, right? The way that we do that is to understand how the King 4 report works, right? And to understand what it is and how then does it link to corporate governance. So the King 4 report is a report that was done, right, in 2016, and it became effective on the 1st of April 2017. So the effective date is a very important date. So when the act or this report became effective is very important, because in a scenario you might be given dates. If the question has to do with King 4 or corporate governance, you might be given a date, and the King 4 is not going to be applicable if it's before the effective date. As much as the King 4 is that of 2016, if whatever you are dealing with occurred before the 1st of April 2017, then the King 4 report is not going to be applicable. So any act that you're going to deal with, you need to understand when the effective date of that act is. Because if you look at this or any other act, it's going to be this act of this, just like the Companies Act, going to be the Companies Act of 2008. But when became effective is what's important, because any date before the effective date, whatever happens is not applicable in terms of the act, right? Whatever happened is not gonna, have any complications in terms of the act. So you're not gonna comply with the act before the effective date. You're gonna comply with whatever act is still effective as of that date, right? So the King Reports on Corporate Governance is a report that looks at giving guidance on how the board of directors discharge their duties in a sustainable way in order to achieve their objective and to become accountable to stakeholders. So what we are basically saying is that the King Report is going to provide guidance on how you can actually ensure that you have corporate governance in the entity, and it will provide guidance on how the board of directors are going to discharge their duties in a way that is sustainable and in a way that is accountable to the stakeholders. So that's what the King 4 report does. It provides guidance on sustainability and stakeholders, and who needs to ensure this? The board of directors. Hence we say how the board of directors discharge their duties. Right, so if we just were to compare the King 3 and the King 4, the King 4, which is the one that is applicable right now, uses an approach of apply and explain, unlike in King 3, where the business had to apply or explain. So what we're basically saying is that we had King 3 before, now we have King 4. King 3 wanted public companies to apply, right, the principles that were in King 3, or to explain why they didn't apply those principles. While King 4, which is the one that is effective right now, wants you to apply them and explain, right? So you're not only going to apply, but you're going to explain how you applied them, why you decided to apply them the way you applied them. So with King 4, you guys can see that it's kind of compulsory for public companies to actually apply, because you can't choose whether you're going to apply or explain why you didn't apply, unlike in King 3. In King 3, public companies could apply, or they could choose not to apply and just explain why they didn't. In King 4, they have to apply and then explain, right? So the reason why I keep on saying public companies is because the King 4 reports is not law, right? But it is compulsory as per, okay, let me say listed public companies, right? Because if you are listed on the JSE, any stock exchange in South Africa, then it is compulsory for you to comply with King 4, right? So if you are a listed public company, it is compulsory, it is a listing requirement for you to comply with King 4. Right, and most of the things that we do here looks at listing companies. You'll see when we get to insider trading that it is also looking at listed companies, right? So as I said, King 4 is not law, but companies which are listed on the JSE are required. It's a listing requirement to apply and explain the King 4. And the King 4 has 17 principles that replaced the 75 principles of King 3. So in King 4, we have 17 principles. In King 3, we had 75 principles. So these are points that you can put in if a scenario asks for the differences between the two. So King 4 is concerned with certain issues, and those issues are ensuring that companies disclose that they are a going concern or not. So going concern means in the foreseeable future, do you expect to still continue as a company? So you're supposed to disclose. You are a public company, right? So you have a great public interest, right? So you need to disclose to your people, to your stakeholders, whether you do expect to still operate in the foreseeable future or you don't. You don't see that you're gonna continue operating. So they need to report on risk management. So they need to tell us, if you think of the King 4 and you're doing auditing, they need to tell us how are they going to manage risk, right? You're going to have all those audit committees, risk management committees, etc. So they need to tell us how they're going to manage risk, and they're going to tell us how they're going to have to tell us how they are going to address stakeholders' interest, and they need to then make sure that they tell us about the triple bottom line, which looks at profit, planet, and people. So they need to report on an integrated reports. They need to report on an integrated level, not just on profits, but they need to tell us how they take care of the environment, and how they ensure that people's needs are met, right? So corporate governance issues that King 4 addresses, right? So King 4 addresses ethical issues, it addresses remuneration policy, it addresses the audit committee, and then it addresses internal audits, integrated reporting, plus disclosure. So you can just know these, just so you're able to list them in an exam, right? And the most important topic, insider trading. Very easy topic. Before we get into the topic itself, I just want us to look at important sections that you're gonna have to remember, right? So the way that I remember this is to sing a song, right? So there's this preacher song that we sing that says Phakamiso 7, Phakamiso 7. So the sections that we have start with 7 and they end with 7. 7 up, 7 up, 7 up, 7 up, 8, 8, 8, 8, 8 down, right? So they end at section 70. They start at section 77 and they end at section 88. Forgive that I can't sing. Please forgive me. But the sections start at section 77 and they end at section 88. So that's just a way for you to remember it, make it a song. I don't know, link it to something you know, so that you are able to remember this. So section 77 is the starting point, right, of everything we're going to cover, all the way to section 88. We're not going to cover all the sections, but important parts of the sections, right? So section 77 of the Financial Markets Act looks at definitions, right? So definitions are in section 77, and then section 78 now lists the offenses, right, of insider trading. And then we move, right, to section 109 and then section 82 and then section 87. So those are the important sections that you're going to have to remember. Section 77, the definitions, scope of prohibition, right, what you're not allowed to do, or the offenses that are there. So section 78, offenses, right? And then section 82, we look at penalties, right? Section 109, penalties. Section 87 says you can have civil claims. So let us go over the content. Excuse me. So insider trading, as I was saying, is governed by the Financial Markets Act. That's not how it started, though. It started to be governed by the Insider Trading Act and then the Securities Services Act. But now the Financial Market Act has fully codified the Securities Services Act. So the only act that is applicable in terms of insider trading is the Financial Market Act. So what we are trying to do is to avoid market abuse. And we are looking at securities, meaning when you're trading in shares, when you're trading in debentures in the market, right, in a regulated market. So we are trying to ensure that there is no market abuse in that market, right? And the Financial Market Act tries to ensure and to minimize and to avoid, have penalties, tell us what the offenses are that they're going to impose penalties on. It also gives us the defenses that a person may raise and be like, no, there was no offense that I did here, right? So what is insider trading? So insider trading is the illegal act of trading on the stock exchange to one's own advantage. So what we are saying is you are trading on the JSE, for instance, to your own advantage by using inside information. So you have inside information and you are using that inside information to your own advantage, and you are trading on the JSE. But what exactly is this inside information that we are talking about, and how can it give you an advantage, right? So inside information, remember, we're still in section 77 where we're looking at definitions. So section 77 says inside information is information that is precise and specific, or specific. So it is information that is precise or specific. It is information that has not yet been made public. And it is information that if it were made public, it would have a material impact on the price. So we are saying you have access to information that no one else has access to. And because you have that information, you are able to use it to your advantage to make a profit or to avoid a loss. And that very same information, if it were to be made available to the public, it would have a material, meaning a significant effect on the share price. Right, and this information must have been shared or must be in the possession of an insider. What is an insider? Insiders are people like your employees, your directors, any person who has access to the information because of their profession. So an employee, for instance, someone who is a CASA working with the financial statements of the entity, and they come across certain information just like a loan from the government. That person is an insider because they have inside information that has not yet been made available to the public. And let's say, for instance, you are a director and you guys just signed a deal with the government, which will greatly improve your entity, right? So that information has not yet been made public, right? But if it were made public, the share price would rise. And you as a director, you decide that you're gonna invest in the shares of the entity. And then once the information is out, the share price shoots up, and then you sell the shares, you make a profit. So that's inside trading. That's an example of inside trading, and that is an offense, right? So as I was saying, Phakamiso 7, Besu Yehlisu 8, right? So 7 up, 8 down. 7, 7, 8, 8, I am the best, right? So 7 up, that's where the section starts. 7 down. 7 up, that's where the sections start. 8 down, that's where the sections end. So the sections start at section 77 and they end at section 88. Right? So section 77 defines things. So it defined what inside information was, and we already saw that information that is precise. And there's information that is precise or specific, information that has not yet been made public. And if it were made public, it would have a material impact on the price. And this information is in the possession of an insider, right? So we're done with section 77. We have explained, we have defined. Now let us look at the offenses that are there, right? So section 78 tells us the offenses. And section 78 actually starts by making it clear that an insider who knows that they have inside information and who deals with a listed company's securities to gain a profit, avoid a loss, or to avoid a loss has committed an offense. So section 78 starts by making it clear that if you are an insider, right, you're an employee, you're a person who knows information because of their profession, you're a director, you're an insider, right? So it makes it clear that if you are an insider, and you know that you have inside information that is specific or precise, not made to the public. If it were made to the public, it would have a material impact on the price. So if you have inside information and you decide to deal with a listed company securities, so because you know something that others don't, you decide to deal, meaning buy shares on the JSE in order to gain a profit or to avoid a loss, then you have committed an offense, right? So there are 5 trading offenses that are listed in section 78. So this is when someone deals with securities for one's own account while in possession of such information. So we are saying you have inside information and you decide to deal on your own account. So you're dealing for yourself. You're buying shares for yourself. The second one says dealing and securities on behalf of a person. So you are an insider, you have inside information, and you decide to be an agent to a principal, right? Or you are not an insider, but you are dealing for a person who is an insider, right? And then the other one, the other offense that we look at is when an insider discloses inside information to another person. The last one is when an insider knows something and they encourage or discourage someone from trading or from dealing. What are then the penalties? Because if we are saying it's an offense, we're saying there needs to be punishment. There needs to be some sort of punishment. And we are saying the FMA, right, Financial Markets Act. So the FMA is going to give us certain penalties that are going to be that we're going to have, right? And section 82 actually gives us his penalties. So these are admin penalties. You're going to have two types of penalties. You're going to have admin penalties, and you're going to have criminal penalties. So section 82 gives us the penalties that we need to have in terms of admin. So what they can decide to do is to take your actual profits, so whatever profit you made because you benefited from the inside information that you had, they can decide to take that information. Or they can give you a penalty, a fine of 1 million plus up to 3 times your actual profits. So they will say pay 1 million, and then whatever profit you made, we multiply it by 3 and you pay that. They can charge you for interest. So let's say you made this profit and they only found out a year later, and you had invested this profits and you made even more profits. So whatever interest that you made due to time value of money, or because you put that profit to good use, they're gonna take that. And the cost of the suit, so they're gonna make you pay for the cost of them investigating you, them trying to find proof, etc. And then section 87 says that you can actually constitute a civil claim. And then in terms of the criminal penalties, section 109 actually tells us this. And remember I said section 77 to 88, but the criminal offense doesn't necessarily come from the FMA, but it is an offense, it is a penalty that comes from the board that deals with this, right? And it's under section 109, and it says you can be given a fine of less or equal to 50 million or 10 years of imprisonment, or both, right? So if a director was found of such acts, they will actually be disqualified, right? So how can a person defend themselves? How can they say, no, I wasn't an insider at the time when I was trading? So remember we said there are 5 offenses, and all the 5 offenses except for the last one where you encourage or discourage, there are no penalties for the last one, so there are no defenses. So for the one where you encourage or discourage, there are no really offenses. For there's not really a penalty for that, so there's no need for you to defend. For the other ones, there's a penalty, so you need to defend. How then do you defend? You can say that you only became an insider after giving the instruction to deal, and the instruction has not changed. So we are saying by the time when you were buying the shares, you were not yet an insider. You didn't have the inside information. So whatever decision you made was not based on the inside information. So you decided to trade, right? You decided to buy the shares. Then you found out about the inside information. Then you became an insider. And since then, from when you became an insider up until now, your instruction has not changed, right? So your instruction, the initial instruction, was not dependent on the inside information, so you can try and use that as your defense. Secondly, the person was acting in a transaction in which, so that transaction to which the inside information relates, that person was acting in a transaction in which all parties in that transaction had the same information. So as much as the information was not made public to everyone, but the transaction that you were dealing with, everybody that had to do with that transaction had the same information, and the trading that you guys were doing was limited to the parties in one. So let's say you're a group of 5 people, and you want to trade on the JSE, only you guys know about this transaction, right? And only the 5 of you can buy those shares. I don't know how that would make sense in terms of public companies, because anyone can buy those shares. But yeah, those parties are the ones that are going to be dealing in that transaction, and the trading is limited only to those parties. So they are the whole markets in that transaction, and all of them knew about the transaction, right? And another thing is that the transaction was not to gain a benefit. So if you were just dealing and you were not just trying to take advantage of the inside information, then you can actually use that as your defense, right? So the last thing that you need to know is that you need to understand that this is for listed companies, and listed companies are public companies on the JSE. And you also need to link this to the fiduciary duty of a director. Fiduciary duty to act in the best interest of the company, to not disclose confidential information, etc. So do not forget the duties of your directors and the fiduciary duty, and try and link it to insider trader. So guys, thank you so much. Bye.